Hey, Larry, in the past, you've spoken passionately about getting everyone, all the boomer people that are getting close to retirement age, the ability to retire, and that we're just not prepared. There's been recent articles written about the Fed and how everything the Fed is doing with well intentions is actually just killing savers, and the people that are doing well, given the Fed's action, are people that own assets, and income inequality is getting worse, and everybody that owns a house, everybody that owns stocks, everybody that has all these things are getting marked up, but not for the right reasons, not because of an underlying organic type growth, and savers are continuing to be just slammed. I mean, are you not worried about the Fed's action at this point? I don't see how they get out. You just said that inflation is probably going to be higher. They're stuck in this box where they can't really stop, and the more they don't stop, the more savers get hurt. So what's the answer long term?
Joe, I think you framed it really well, and I've been talking about that for years, about the silent crisis of a retirement. And unquestionably, as central banks keep rates low or negative in Europe, the savers are getting slammed. And you're absolutely correct. Asset owners are the biggest beneficiaries of monetary policy. And this is why I think a year ago, 2 years ago, I talked about we need a more fiscal stimulus and maybe less monetary stimulus. And so there is no question savers are being slammed, using your word, and that is a persistent problem, and that will remain a bigger problem. Much of this has to do with, this is one of the reasons why we're seeing many of the savers are now more confused. And I think some of them are now finally entering in equities and other asset categories as a part of it. I think, as you remember, on your show a number of years ago, I was asked, what should be your asset allocation? I've always said 100% in equities. Not that I predicted where monetary policy will be, but unquestionably, we are going to have to address what I would call the silent crisis of retirement. People are going to have to, unfortunately, if whether they like it or not, they may have to work longer because they're not earning the same returns on their savings. On the other hand, if you had a balanced portfolio over the last year, you've done quite well. You may be being hurt on your bond or cash allocation, but in your equity allocation, you've done quite well. And for those who own homes, obviously, they've been a big beneficiary of rising asset prices.
I don't want to work for the next 40 or 50 years so then when I retire, I'm too old to enjoy my retirement. So you can work for somebody else, save 10 to 15% of your income every month, live very frugally, and invest in very safe investments. Then when you turn 65, collect Social Security and retire. I want to retire earlier than that. All right, well, why don't you save maybe 20 to 25% of your income every month, still live extremely frugally, but then invest in some risky investments. Maybe they'll do good, maybe they won't. If they do really good, you can retire at 60. I still don't want to wait that long. All right, well then just do what I did. Buy rental property using other people's money, become a millionaire through the equity, and create a passive income source that is greater than your monthly expenses. You can retire in 5 years. That sounds better. I'm gonna follow you. If I did it, you can do it.
Many people have a single approach to retirement called a 401k. It replaced pensions because 100 years ago, a government would actually, a business would give you a pension and take care of you till you died. And then companies started going out of business saying, that's really expensive. We need to put it on the people. So the government gets involved and they institute the first concept of 401k. Everyone says, this will save me. I'm going to do this. Companies will give me a match. It's seductive. I put in 3%, they match 3%. How many of you have heard of this stuff? Now, $63,000 is what the average byproduct is after 40 years. Is that number exciting or terrifying? That's a very scary number. Why is it scary? How long is it going to last? Let's say the number's 200 grand. Is that an exciting number or a terrifying number? Because $200,000, how long is that going to last?
There are a couple things about being an old guy that actually help. For instance, I remember the last crash, and the one before that, and the one before that. So you go all the way back to 1987, and these crashes are all the same. A bunch of people standing around afterwards, they're barbecuing in the backyard, and the wife's saying, yeah, I don't know what happened, he's in charge of the money, and he's standing by the barbecue flipping burgers saying, oh, geez, I mean, who could have seen that coming? Everything was seemed great. I mean, everybody said the market was going to go up for another 5 years, and then all of a sudden, boom. The S&P 500 right now has almost half of their stocks below the 50-day moving average, and yet it's still going up. You explain that one to me. JP Morgan on Friday said that they expect a 20% or more market correction. Morgan Stanley came out today and said they expect a market correction. Are you literally just going to watch your IRA, your 401k, and all your investment portfolio go down the toilet? Really?
But first, we need to talk about entitlements and the retirement crisis facing America right now, a real issue. And it's a serious one. It's been a long festering wound that needs to be addressed before we have to amputate this thing. Now, if you go back many years on this channel, you'll see that I've been sounding the alarm, and it's not gotten any better. It's still a problem. A potentially devastating one that's only getting worse by the day. Now, here's a little history for you. I was a history major, so let me share a little with you. Little has changed in a half decade. The US government's biggest role is still robbing Peter to pay Paul. Well, how do they do this? Well, they do it all through entitlement programs, from the mighty Social Security and Medicare down to food stamps. Now, this spending from the government is now closing in on 70%. That's 70% of what we spend. Then you add in the interest and our increasing debt, and we are in for a world of hurt.